as Becca mentioned, this is going to be the first part of a two-part series, and both are focused on a financial statement. So in accounting, financial statements are really the basis for everything that we do. The reason accounting exists is for record keeping, to have information to be able to produce financial statements for a variety of reasons, and then depending on the company, provide information to the public or to investors or shareholders. So this first part is focused on the balance sheet, which is really the foundation of accounting. And then the second part is going to be based on the income statement. And I think there's concepts weaves between that can be applicable to both. So I hope this is going to be just some good foundational knowledge for you as we go forward. And to Becca's point, there are going to be times where I stop and want to just ask some questions and have some conversation. So for those of you that are in, I may call out and say, hey, what are your thoughts on this? Just because I want to keep this interactive, because I'm going to make two promises to you today. One, this will not be the most exciting thing that you ever learn. I promise you that. My second promise, though, is I hope it won't be the most boring thing that you ever do in your life. I want to get somewhere in the middle, and I think the way we do that is to keep it interactive together. So moving ahead here. First slide, history of accounting. I know you just heard me say this won't be the most boring thing that you've ever learned in your life. And I just pull up a slide that says history of accounting. But I do like to do this when I teach these classes, just to give you a little taste of like, where does accounting really come from? And the answer is, it's been around for hundreds and hundreds of years, starting from older civilizations that needed record keeping all the way to now where we have these really advanced accounting systems. But there's actually one individual that's really known as the father of accounting, and that really led the charge to more modern day accounting practices. And that was a guy named Luca Pacioli, okay? And he existed around 15th century Italy. He created what we now know to be double entry accounting. And what that means is, you think about cash, right? Let's say you get cash in the door. Single entry accounting would just be saying, hey, I'm going to record somewhere that I got cash, and that's it. But double entry accounting, and this is really setting the stage for what we're going to talk about today. Double entry accounting is saying, hey, I got cash. Now, why did I get cash? And then you got to make an entry somewhere else. So it's double entry. You have to always explain why you're making one entry, and that's where debits and credits come into play. You may think of debits and credits within your own personal bank account. You get money, you get credit to your bank account. It leaves it, you get a debit, right? It's the same similar concept in accounting. Debits and credits increase or decrease accounts, but there's always two sides to every equation, which we're going to dig in a little bit more. Other fun fact, Luca Pacioli was a friend of Leonardo da Vinci, and he actually taught him some stuff. So if you ever take one thing away from this class and you want to maybe try to impress someone, I don't know how that's very impressive, but you could say, hey, I know that Luca Pacioli was the father of accounting. He was friends with Leonardo da Vinci. So there's your fun fact for the day. So now we come to the accounting equation. This equation that's up on the screen is the foundation for pretty much everything in accounting. And it's assets equals liabilities plus shareholders equity. This is the way a balance sheet is constructed. It's the foundation for everything that goes into accounting. It's the fundamental accounting equation. And this is my first part where I'm going to ask some questions. So can someone just shout out, what are some assets in your personal life or in your business? It can be anything. Just shout something out.
Equipment.
Exactly. Equipment. What else?
Cash.
Cash is a big one. Cash, we love that asset. Give me one more.
What about accounts receivable?
Accounts receivable, that's a great one. Exactly. So assets are anything that give you economic benefit either now or in the future. So cash, that's money that you have in your pocket or in your bank account. Accounts receivable, that's money that's going to be coming to you in the future. Equipment, that's you've paid for that. You have that equipment. It's giving you benefit because you're using that equipment to run your business. That's economic benefit to you. So assets are anything that give a business economic benefit either now or in the future. So now let's go to the other side equation. Then I'm going to talk about that little sentence at the bottom, what you have and how you got it. Liabilities. That's the other side of this equation. What are some liabilities that you have in your personal life or in your business. And really, textbook definition of liability is things owed to someone in the future. Okay, so that could be a creditor, that could be another business. Something that is owed in the future is a liability. So what are some things that you have in your business or your personal life in that category?
Loans.
Exactly. Loans are a big one. Mortgage, car loan, student loan. There's another big one. Whoever mentioned accounts receivable, I'm looking for the other side there.
Accounts payable.
Exactly. Boom. Accounts payable. Thank you very much. You owe money to someone in the future. You are going to have to pay for something. That is a liability to you and to your business. Loans. I have plenty of them. Student loans. Everyone does. But those are a liability because you are going to have to pay for that. So it's money owed in the future in your business. Shareholders equity, I'm not going to spend a ton of time on today because that's where you start getting into like stock and things like that. The one thing I will call out about shareholders equity, and this all once again flows into the balance sheet. Within shareholders equity, we have something called retained earnings. What you need to know about retained earnings, if you don't already have an understanding, is your net income, and that's really part two, talking about the income statement, revenue minus expense. At the end of the day, equals your net income. That flows into retained earnings, which flows into shareholders equity. So all that leftover income that you have after your expenses flows into shareholders equity, which is as part of this equation. All right, so we've talked about assets, we've talked about liabilities. Sounds like we have a good foundational understanding of what those are. And this sentence here, what you have and how you got it, when I teach these classes, that's how I like people to think of this equation. It's almost like you can read it. So what you have, that's your assets, your cash, your inventory, your accounts receivable, your equipment. Then you have to ask yourself, okay, now how did I get it? And then you move over to the right side of that equation. You have cash. Did you get a loan for that cash? That's a liability. So you have your cash. How did you get it? You took out a liability, a payable, and that's part of the liability side. Because the thing about this equation is both sides always have to equal each other. So if you took out a loan for $20,000 and you got $20,000 in cash, there's a $20,000 liability loan on the right side of that equation. So they always have to balance. Debits always have to equal credits. That's the nice thing about accounting. At the end of the day, we always want to balance, right? And you can really kind of think through that as this is what I have. These are my assets. Now, how did I get them? Then you go over to that right side of the equation. Did you have revenue? That's part of shareholders equity. Did you have a liability or a loan that's part of that liability section? So that's kind of a way to think through that equation and really apply it both to the balance sheet, because once again, this is the format of a balance sheet or any other really accounting concept. So let me pause there. Any questions on that? Because I like to really hone in on this equation because it really does form the basis for a lot of other concepts.
Hey, Zane, Charlene asked a good question, a really relevant question. My camera, there we go. So thinking about small businesses and single owner businesses, can you help us understand how shareholders equity is applied? Like if I own a business, how is my shareholders equity a liability?
Right. So shareholders equity, so that's a great question. And I think it's good to differentiate. So shareholders equity is not a liability. It's its own separate section. It's just part of that quote right side of the equation. So if you think about shareholders equity, it's really the equity that exists in the business. So for a small business, I think of, money that you've invested into your own business, or maybe money that other people have invested. That's part of that equity section because, that once again, thinking about what do you have, how you got it, money that people have invested, that could be a cash, an asset, or some other asset, and how you got it. Well, you have to recognize it in equity because that's money that's been invested into your business. Thinking through the retained earnings section, which once again, that can get kind of confusing. But when you take your net income from your income statement, that flows into retained earnings within this financial statement. So thinking of how this could be applicable to small businesses, that income and that's left over from those revenues and expenses really, exists within shareholders equity if it's not used for something else. So I think it's just ultimately, you can kind of think of it in the same ways, maybe equity that you have in your home or something, right? That's value to you. And it's really made up of investments that you've made into any business. Just to help clarify too, like if you look at it from, I know stock kind of gets weird, depending on how businesses treat that. But, for larger organizations that issue stock, to raise funds or what have you, that stock that's issued is recognized in equity because that is the shareholders' ownership within the business. Does that help answer the question?
Yes. And I just had a follow-up question regarding whether or not it's a tax deductible on your income when you file your taxes. Do you get to deduct the shareholders equity?
Yeah, so I will be the first to admit I am not a tax expert, and it's actually kind of funny because people see the CPA title and they think, let me ask them questions about taxes. And realistically, tax is like a very specialized field. So I'm probably not the best person to answer that question, but what I would say is like the deductible expenses and things like that, that's probably going to come more from your income statement side of the world because those are like your actual business expenses that could be tax deductible as opposed to the balance sheet. The balance sheet is really more of a, it's kind of separate from the income statement. It's really just a snapshot of what you have existing within your business when it comes to
that makes sense.
Yeah.
That makes sense. Thank you.
Yeah, absolutely. Great questions though.
And if I could add, thinking from a, if you're working on building your financial statements to be as solid as they can be so that, a lender, for example, might look at them and see your business as strong. Shareholders equity is a place that's going to show the skin in the game that you've put in and invested in your business, and to show that you've reinvested your earnings in your business or you've put dollars into your business yourself that came not just from loans per se. And it really is also the place that's showing the wealth that you're building within your business.
Absolutely. Great. All right, we can keep it going here. So talked about the fundamental equation, all right, for accounting and kind of what goes into that. So another big topic concept that comes in within accounting is this idea of accrual basis accounting versus cash basis accounting. Now, for certain organizations of a certain size, accrual basis accounting is required. But then for a lot of businesses, they tend to just use cash basis. And the difference is these two statements here. So accrual basis means you recognize income in your books or in your financial statements when you earn it. Cash basis accounting means you recognize the income when you receive it. It's all about that handoff of cash. So the way you can kind of think about it is, let's say you have a business and you make a sale in January, okay? But let's say you invoice the customer and they don't have to pay you for 60 days. So you would receive payment in March. Accrual basis accounting would mean that you recognize that revenue in January when you earned it. And then we'll talk about in a second kind of the accounts receivable aspect of that, because I know I've heard some of you mention that so far. Cash basis accounting would say you're going to recognize that revenue in March when you receive the cash. So for a lot of businesses, cash basis, it's just, it can be easier to keep accounting records about cash basis because you don't have to worry about, that timing between the income and actually when you receive the money, which we'll get into in a second. But the argument for accrual basis is really, it's better tracking, right? It helps you better track when revenues exist or when you actually earn that revenue. You earned it in January, right? When you sold that product or you delivered that service. You didn't earn it when you received the cash. I know it's kind of a weird concept to think through, but it's really about when did you provide that good or service? That's when you earned that income and earned that revenue. And accrual basis says that's when you should recognize, which really just means record that entry in your books or on your financial statements at that point in time, not when you do the cash. That's cash basis when you recognize it when you receive that money in March. Flip side of that, so we just talked about the revenue side of the world. You can also look at it from expense side. So accrual basis accounting says to recognize expense when you incur it versus when you pay it. So on the flip side, right, let's say that you purchased a good or service in January, and you incurred that benefit because you either used the good or you used the service, whichever that is. But let's say you get invoiced and you don't have to pay for it until March. Accrual basis accounting says you need to recognize that you had that expense in January because that's when you incurred the expense and utilized the benefit. Cash basis accounting would say you're going to recognize that expense in March when you actually pay for it and that cash leaves your bank account. So, these two concepts can be complicated because they're used in different ways. Sometimes, businesses may try to like keep books and records on accrual basis, but when it comes time to actually produce a financial statement from QuickBooks or whatever system that may be used, they'll kind of convert to cash basis. So it can get a little tricky, but the idea here is accrual basis. Even if you may not be using it in your day-to-day business, those kind of concepts of really recognizing your expense and your income when you earn it versus when you actually pay or receive the money is a better way, or can be a better way, to track that income and track that expense and really, target it to when you earned it. Any questions on accrual versus cash basis? I know this can be sometimes a tricky concept. And I'm sorry, I don't know where I'm not really well versed in Zoom. I don't know where the chat is, so I can't see those. So I'm sorry, I don't know if anyone's typing questions.
I've got the chat in front of me. Kenan asked a great question that you can build in at any point when it fits into your presentation, but it's something that I've always struggled with in my accounting career as well back in the day. For debits and credits, is there an easy or sensible way to remember what to debit and what to credit and when? And it's easy to get them confused.
Yeah, that's a great question.
Pro tips.
Yeah, great question. And I can go ahead and weave it in now. So so when I teach these classes, a lot of times I will get either people that have come from banking backgrounds or people that, just everyday people who have a personal bank account. And the debits and credits get very confusing because in your personal bank account, credits are a good thing, right? You're getting money. Debits, money leaving your bank account. It's different for accounting, okay? It's almost like reversed. So the easiest way I can kind of lay out, what to debit and what to credit and why is, once again, going back to this equation, this fundamental accounting equation. So assets are on the left side of the equation. We call them, left side. You can call it like left side entries or left side equation, what have you. But assets are on the left side. Assets, as a rule, there's exceptions, of course. There's always got to be exceptions. But holistically, assets are increased with debits. So asset accounts, if you're increasing the balance because you've got cash or you've got inventory or you purchased equipment, and you're going to need to increase that asset balance, as overall, asset accounts are increased with debits. On the flip side, if money is leaving your bank account or inventory has gone away, what have you, asset accounts as a rule are decreased with credits. Okay, and that's the left side of the equation. Assets, think of them as good thing. Debits increase the balance in assets. Credits decrease the balance in asset accounts. On the right side of the equation, it's flip-flopped. Okay, so liabilities, those accounts, if you need to, you're recognizing that you have a new liability, you need to credit the liability accounts to increase them. And then if you're paying off a loan or you need to decrease a balance in the liability account, you debit the liability account. Once again, this is a general rule. So that's kind of, and then equity, once again, this was always a little bit more confusing because of the way that the transactions flow into equity. Because expense accounts, which, are really more of an income statement account, right? Those are increased with debits, it's on the right side of the equation, kind of. So you think, oh, well, should it increase with a credit? But expenses are kind of the different types of transactions. But most of the time, you're looking at assets and liabilities, and it sticks to that rule. Assets increase with debits, decrease with credits. Liabilities decrease with debits, increased with credits. Then maybe it can be like written down, so that's a lot of words. But taking it back to this sentence what you have and how you got it, and knowing that debits and credits always have to equal each other. This is something that you can almost kind of do in your head as you're trying to make these entries, right? So let's say, going back to a previous example, you took out a loan, right? Which is going to create a liability. And from that loan, you got cash. Say it's $20,000, and you need to make that entry in your books. Cash is a good thing. It's an asset. As I just said, asset accounts are increased with debits. So when you're making that entry and you're making it to cash, you're going to debit your cash account for $20,000 because you got cash, an asset, they're increased with debits. You always have to have another side of the equation. That's double entry accounting. Good old Luca Pacioli, he created that double entry accounting. You have to have a credit with your debit. So what you have is your cash, how you got it. You took out a loan, you have a liability. Liability accounts are increased with credits. You need to credit your loan payable or what have you liability account. So that's a way you can think about it, along with those kind of generalized rules. Does that help at all? I know that's a lot of words.
That does help a lot. Thank you.
Absolutely. Great questions. Thanks. I really like these sessions are a lot better when people are asking questions and engaged. So I really appreciate it.
Yeah, whenever I've engaged with accountants, it seems like they're making it up as they go. So that was a very helpful explanation. Thank you.
Yeah, Ken. And sometimes I like to joke around. Accounting should not be creative. Okay, if you're doing creative accounting, that's probably not a good thing. Okay, accounting is not a creative. So it's complicated, and there's sometimes you got to get creative in the way you think through concepts and rules, right? But at the end of the day, the thing for people that enjoy the kind of structure that accounting brings is that oftentimes everything's got a balance. You got to have every debit for a credit and vice versa. And it's just all about how you think through the entries and what you got to make. And I always take it back to that fundamental equation to help people think through those entries. Okay. All right. So we can move on to accounts receivable and payable. So let me just ask a general question so far. How many of you utilize accounts receivable or payable in your business? And if not, totally okay. Just out of curiosity, or even like the concept of accounts receivable or payable.
I do.
Okay. All right.
I do.
Great. So for those of you that may not, so accounts receivable and payable, they're really more accrual basis accounts, right? Because, as I talked about in that last section, recognizing expense or income when you earn it versus when you receive it, in order to do that, you have to have kind of like a pass-through account until you actually receive or pay out the cash for the income or for the expense. And those accounts are accounts receivable and accounts payable. Both of these are balance sheet accounts, tying into our balance sheet theme here. Accounts receivable is an asset account because it is money that is due to you in the future. So it's going to give you economic benefit in the future. It's an asset account. Accounts payable is money that you're going to have to pay out in the future for a loan or something that you purchased, what have you. So it's a liability account. Once again, both on the balance sheet. These are standard accounts for accrual organizations, and really a good way to track money that is due to you or money that you're going to have to pay out in the future. And I like to, when I talk about these accounts, I like to use a drive-through example. So one time I was teaching this class, and I had somebody, a class like this about accounting basics, and I had somebody, raise their hand and say, I kind of get what you're saying about accounts receivable and payable. I kind of get what they mean, but talk to me about it in terms of McDonald's. I love McDonald's. I'm not gonna lie. I love a Big Mac. So I immediately said, you know what? Okay, I'm gonna do this in terms of McDonald's. So I want everyone right now to kind of picture a drive-through at McDonald's, okay? Or whatever your fast food place. Or if you don't have fast food, you don't like it, whatever. Think of a drive-through. But pretend that you get your food at the first window, okay? And you pay for your food at the second window. If you are the fast food organization that has the drive-through, from the time that you provide that food to that customer at the first window, you have earned revenue because you have furnished that food, you have provided that product that that customer is going to go enjoy. That is revenue to your organization because you have you have delivered that food. You haven't received the money yet, but you've delivered that food, and that's when you should recognize revenue according to the accrual basis standards. From the time between the window where you provided that food and the time where the customer paid for it, you have an accounts receivable, right? Because you haven't received the money yet, but you're going to receive the money. So you need to create an accounts receivable entry in between that time. And then once the customer pays for it, you get the cash, and then you can close out the receivable because you're not due that money anymore. But just focus in on that time between the first window and the second window. That's an accounts receivable to that fast food organization because they deliver their product, they've recognized that revenue, and then until they get paid for it, they have a receivable. Going back to tracking, this is obviously a very, like no one would realistically set up a receivable for a drive-through window. But if you just think about, what the concept's trying to tell you, let's pretend, there was months gap between those two windows. Recognize that revenue at the first window. That's when you really sold the product, right? That's when you earn that revenue. Them paying for it, that's just down the line. So that receivable helps kind of bridge that gap. On the flip side, looking at the accounts payable entries, let's pretend you're the customer, okay? So you purchase your food, you go to that first window, and you get that food. You enjoy it, you're happy, you're at that first window, you've gotten that product or service. That at that time, for an accrual-based organization, is expense because you have received that product, you have begun receiving benefit for it. That is when you need to incur and recognize that expense. Then between the time you drive to that second window when you pay for it, that's when you have your accounts payable because you have your product, but you haven't paid for it yet. You need to recognize that you have a liability, so you make an entry to accounts payable. Once the customer gets to that second window and they hand over the cash to pay for that food, they close out the payable because they at that point in time have provided the cash to pay off their liability. So, the kind of drive-through concept, I think drive-through, this is what I found to kind of help think through what accounts receivable and what accounts payable accounts really are. And thinking through, okay, well, how this is applicable to me, using these accounts receivable or accounts payable concepts in your business can have multiple benefits, right? It can help you better track revenue and expense to when it actually happened versus when you paid for it. The other thing is too, right? Let's say you get invoiced for something and it's net 30 or net 60-day terms. Normally, money in your hand now is better than money in your hand a couple months from now, right? So, oftentimes it's a good suggestion to wait and pay for that invoice later on down the road if you have those terms, just in terms of a cash flow perspective. So having an accounts payable account and a good tracking mechanism to know what bills are due and when can help really manage that cash flow perspective and your expense. So few concepts there about accounts receivable and payable. Any questions or thoughts on the drive-through concepts or anything about these two accounts?
I don't have
Does
a
it help?
question, Zane, but I would love to say that this point that you made about leveraging the payable terms to be beneficial to your organization is one that I think is like, it's a very small point, but really powerful point, because cash flow is something that every business struggles with, and working capital. And to be able to keep the cash in your pocket for as long as possible, not that we're in an environment where we're earning much interest on our cash, but just having it available to use for everyday operations, and having the benefit of paying, of not giving that asset away until you have to, I think is one to really consider.
Yeah, absolutely. Very good point. And I think it ultimately comes down to, once again, accounting is, it's the language of business, right? And I really found that to be true. Accounting is the foundation of everything. And ultimately, right, you need accounting to have your financials, to have your books of record, but it's also can be a really great tracking mechanism, right? To track payments that are due to your business, within your books of records, and understand what your liabilities look like and when they're due and how to track them. So, I think it's just multifaceted in terms of how accounting can help your business. Does this help? Like, does this kind of make sense to anybody? I mean, anybody, maybe even those of you that, work with accounts payable and receivable every day, is this kind of aligned with how you think of these accounts?
I think it's really helpful. And in my situation, the way my clients pay me, like what I do notice is that, like, if I don't put a due date on my bills, they don't pay you in a timely fashion. So like, I feel like I have to have a due date and a late fee in order to collect, because I pretty much sell advice for a living. So, once it's gone, it's gone. But I see why they do that, because they want to hold on to their cash. So I totally get it. But yes, I think it's very helpful.
Great. Okay. All right. So, and actually, this is my last slide. I know we moved a little quickly through here, but we can definitely go through this and then open it up for any other questions or thoughts you want to ask. But all throughout this morning, we've really talked about balance sheet concepts. We talked about the fundamental accounting equation: assets equals liabilities plus shareholders equity. We talked about accrual versus cash basis. We talked about accounts receivable and accounts payable accounts. All of those things. Think about the title of this webinar: assets, liabilities, and equity. It all is about the balance sheet. And the balance sheet is a standard financial statement and report that businesses, use and export. And it's really a snapshot at any given time of what the state of your business looks like from an assets and a liabilities and an equity perspective. This slide is just a super, super basic balance sheet, just to kind of help illustrate how this all ties together. So we think about assets. That's on that left side of the equation. So in this balance sheet, there's $25,000 of cash, $15,000 of accounts receivable, which just once again that's money that's going to be due to you in the future. It's economic benefit. It's an asset to the organization. Inventory, right? That's economic benefit, because you're going to be able to sell it for cash in the future. In this sample balance sheet, all of those accounts add up to $70,000. Right? So keep track of that. Then we go to thinking about, once again, to the equation, the right side of the equation: liabilities and shareholders equity. So in the liability section, we have accounts payable of $25,000. Long-term debt, just a long-term loan that's going to come due at some time. It's $25,000. So total liabilities in this balance sheet is $50,000. Looking at equity, I just put some random numbers here. Common stock, $5,000 if there's been stock issued for this organization. Retained earnings, which once again is money that's been invested or reinvested in the business from that income, $15,000. So total shareholders equity is $20,000. 50 plus 20, $70,000 for total liabilities and shareholders equity. Total assets is $70,000. They balance the balance sheet. That's exactly what this all means. Assets have to equal liabilities plus shareholders equity. So I think, hopefully this is a good visual. If you aren't already familiar with the balance sheet layout, once again, this is a very simple one. But I think it just illustrates really what we've talked about today is, how assets and liabilities and shareholders equity interact with each other. It's what you have and how you got it. The equation always have to balance. Your debits have to equal your credits. And these things really flow in together to tie out and ultimately balance at that time. So, balance sheets are a very useful financial statement, because it helps you see what you have existing in your business in each of these categories, and snapshot in time. And it's just a really good tool. It's an important one as well, along with the income statement, to really track and understand the financial state of your business. So any questions on this sample balance sheet or any of those concepts?
Yes, I have one. How does the profit and loss statement and the balance sheet, when a bank is looking at it for comparison, what areas are they looking at to make sure it lines up? Because that's why I have a challenge with trying to determine whether my balance sheet and profit and loss statement are lining up.
Right. So if you think about your profit and loss statement, the kind of general way a profit and loss statement would be organized is you'd have your revenues, Then you'd have your kind of cost of goods sold, which are your expenses that are directly tied to your revenues, right? And then you'd have your margin, we call it gross margin or gross income, because it's all about the sale of the product and the expenses that went along with it. And then below that sort of margin line, you have some businesses can call it, SG&A, selling, general and administrative expenses, kind of other expenses. These could be they're also called below that initial margin line. So it could be advertising expense or marketing expense or electricity costs, things that go into your business and are expenses to your business, but don't necessarily have to do with, that aren't directly tied to the revenue or product that you're providing. Once you take those other expenses from that first margin line, that gross income, that's when you get to your net income. And then as kind of like a generalized rule, that net income flows into retained earnings, because that's retained earnings, just as a concept, is just money that you've retained in your business. So if you have that leftover cash, and from that net income, that goes into retained earnings. Retained earnings is right here on the balance sheet. This $15,000, that's where that net income, that's the tie-in to the income statement, is into retained earnings. So I think, the way, it could be a question of, maybe the way they're laid out or where the tie-in is at the end of the day, but, as a concept, it really should flow into retained earnings.
Thank you.
Absolutely. All right. That is actually all that I had prepared for today. I hope this was helpful. I know we got some more time left. You can ask me anything, any questions at all that you have from anything we went over, if it made you think of another question.
Hey, Zane, this is Kenan. First of all, let me just say that this is a sensational review of the balance sheet, so I certainly appreciate it. I mean, I've gone through a number of accounting classes and the like, and I really appreciate the way that you've just kind of made it, the information usable. So thank you. I'm not even sure how to phrase my question. I'm wondering what your thoughts are on just sort of the day-to-day management of the balance sheet, right? I mean, I think that, and maybe I'm off base here, but my sense is that small businesses I certainly do, tend to focus a lot on the P&L and don't necessarily focus on the other components of the balance sheet. Can you speak to that? I mean, how would you advise a small business owner to go about his or her daily sort of accounting activities?
Yeah, so that's a great question, and I'll be totally upfront and honest with all of you too. My background is definitely not small business accounting. My background is in more larger corporate accounting, where we have to use accrual basis and we have to release all these different financial statements. So when Becca initially approached me about doing this, I actually went and did a lot of research on small business accounting and how it all flows together. And that's actually kind of one of the things I found. And even just having conversations with Becca is, the P&L, that's the big one for small businesses, because at the end of the day, you want to know, are you making money? Do you have profit? What do your expenses look like? But I think where the balance sheet comes in is really, and I think at the end of the day, it really gets to that accrual basis versus the cash basis, and understanding is knowing that, when you have revenue, when you get revenue, you have an asset, right? At some point, either that asset is a receivable because you're going to get money in the future, or it's cash because you got paid at the same time that you earned that revenue. There's always that balance sheet, or there's oftentimes that balance sheet interlay with the transactions. So I think the way, when I think through how this can be applicable to a small business, is whatever tool that you're using, whether it's QuickBooks or some other tool, make sure that you research and utilize that functionality to make sure that the entries that you're making are truly those double entry accounting entries, and that you're utilizing all of those different quote balance sheet accounts, whether they're accounts receivable or cash, and linking that up to your actual bank account where all your cash lives. I think it's thinking through what the entry really is telling you. reading through that fundamental equation. Hey, this is what I have and this is why I have it. So I think it's, like I said, knowing the accounts are there, utilizing the different functionality, but really trying to, in some ways, like, introduce maybe more of that accrual basis concepts into your business with the receivables and with the payables. And knowing that at the end of the day, while the P&L is definitely, I think, the big one, right? Because you can see that profit. In the second part of the series, it'll be totally income statement, profit and loss statement based. But knowing that at the end of the day, the balance sheet is the foundation, right? That's where you see where all of the work that you've done on the P&L is coming into the snapshot of your business, and knowing what your assets and your liabilities look like. It's a really important, just picture of the overall health of your business. And that goes for any business. So I think it's just maybe placing focus on it and then, really working through how do these accounts interact with each other.
Zane, you make a really good point about it being a snapshot. So I can help a little bit from the small business angle. For example, I have done during the first PPP round last year, I was working for a Virginia Community Capital at the time. This was before I had the benefit of joining LISC. And I was helping process those loans and just answering the inbox of folks who were sending in their documents and making sure all the documents were correct before even sending them over to our lenders. And what I was sharing across the board with folks was, we expect to see especially for mid-year reports of how your business is doing. With your income statement, that is something likely, if you're and not to make assumptions here, but for a business who's really on top of their game financially, in a perfect world, you're going to have a monthly income statement. So you're probably going to spend some time, or your bookkeeper is going to spend some time every month, so that by, after the month ends, in the first couple of weeks of the next month, you're truing up your bookkeeping system, whether it be paper or QuickBooks, and you're ending up with what's this month that we're in? Who knows these days? April. So let's say I'm finishing up my March income statement, my profit and loss statement. And at the end, it's going to have a net income that is based on all my revenue and then all of my expenses. And what you can do at that same time is flip over to your balance sheet. And that number of net income is going to travel over and live and be replicated on your balance sheet in the shareholders equity section. And where that's going to balance out on the opposite side of your balance sheet, the left side of the statement or the top side of the statement, is probably in cash. And when I link it to my personal life too, for example, I also have a lot of debt. So I'm working to pay off my student loans, my wife's law school loans, my credit card bills. And every month I check my credit score to see how, so I go into my Capital One and, there's like that little free tool. And I want to see how that credit score has increased by 1 or 2 or 3 or 4 points, usually 0 or 1 point. Based on the payments that I've made. So it's sort of like, what I think about the income statement is me earning money, trying not to spend too much money on, J. Crew factory sales or, going out to dinner, which I don't do much of anymore, and having more of that net income to pay off my liabilities. And then I look at my credit score every month to see how much healthier I look. It's really that balance sheet that's showing how much healthier you look. And, the more every month, the more your liabilities are able to go down if possible, and or shareholder equity increasing or cash increasing. You can have a monthly balance sheet just like you have a monthly income statement. And it's a snapshot in time, whereas with your income statement, you can have a year-to-date income statement, or you could also show separate monthly income statement. but the balance sheet is always going to be, you're not going to have a balance sheet for a solo month. It's always going to be sort of cumulative. Like, this is the state of my business now, given everything. But it can be updated monthly. And if you can find a way internally with your business to get those to true up monthly at the end of the year, or at any point in the year when somebody's asking you for those documents for a grant application or a loan, application, you are going to be much more likely to apply because you're going to feel ready for it, and it's not going to feel so stressful.
Yeah, that was a great explanation. I think it comes down to they're synergistic, right? These two financial statements, they work together. And, I think the more that you can, like Becca said, try to find a way to implement them, because they tie together, and both of them together are what's going to give you that really good holistic overall view of your business and the health of your business, and the accounting records. They're both extremely, I think, important. The P&L is the one that gets a lot of the attention, right? Like I said, because that's where you see that income come through. But the balance sheet, to Becca's point, that's the cumulative. That's where you see all of that hard work kind of just being built in cumulatively. So they go together. So I think the more emphasis you can kind of just look at trying to implement it or reviewing it, I think that'll be really impactful.
And also, no shame if you're starting from scratch here. Like, I will tell you, from having talked to so many businesses during the PPP process, folks were able to provide me P&L statements, but a lot of folks said, one, what is a balance sheet? And two, okay, I know what it is, but I don't have one. And we literally just had to create a spreadsheet on the spot to have something to provide to the bank. And it was, very, very basic, but it's okay to start from scratch and build one, and we can help you with that. And we can tie, and if you work on that between now and the next session, which, by the way, is April 21st at 8 a.m., those would be great questions to bring to the next session.
And look, if they don't balance, don't be discouraged. If they balance the first time, I would think something's crazy, okay? Because these things, try and get them to balance, it can take a little bit. I remember when I was having to do, either like when I was going through the CPA process, like I said, getting them to balance on the first try is like 1 in a million. Okay, so just keep at it. Don't get discouraged either, because it can just kind of take some time. Starting from scratch, just trying to put it together. It can be complicated. So.
This has been great, and I applaud you, Zane. I also agree with everybody that's been chatting about how I love your demeanor and how you present. It's you're right. Accounting can be a little dry sometimes, but you made it really fun, particularly with the drive-through.
Yeah. Well, I hope I delivered on both of those promises. That I'm sure it wasn't the most exciting, but hopefully it wasn't the most boring. So.
Yeah. Thanks so much. Any other questions before we wrap up? I think we're going to give a few more minutes back to your day. And this has been recorded, as I mentioned, so we'll be sure to send it out to those who couldn't make it today, but also those who are here. So.
And if you'd like to, I know that everybody's sort of on the spot and it's 8:56 a.m., but between now and in 2 weeks from now, when we have our next sessions, feel free to shoot any one of us an email from the contact email that you have received to get this webinar with statements or questions about the hardest part in your operating business, about getting the accounting right, getting the bookkeeping right. And even if it doesn't fit exactly into these presentations, I would really love for us to be able to sort of untie those knots with you on the things that keep you up at night.
Great point. Thanks, Becca. All right.
Great session. Thank you, guys.